It doesn't matter if you use Roth accounts or not, because you're going to end up paying the same costs either way sooner or later. Or are you? There are at least two ways you need to think about the question of doing Roth conversions or contributing to Roth accounts. One of them is the basic math behind Roth accounts, and the other is long-term retirement planning concepts. Starting with that basic math, we can look at something that a lot of really smart people have a hard time even believing or understanding. So let's walk through it. You've got your pre-tax on the left and your Roth on the right, and we're going to say that tax rates are the same both today and in retirement, 25% in each case. Now you've got $100 available. This might be income if you're still in your working years that you're receiving, or if you are retired, it's $100 that's in a pre-tax retirement account. You're deciding what to do with this $100. That's the whole point here. We're deciding what happens with the next $100 that you either receive or it's sitting there that you're going to do something with. So in the pre-tax account, if you contribute it or just leave it there, there's no tax due because we're going to assume that's a deductible pre-tax contribution. So the full 100 gets invested. And then over some amount of time, the money doubles to $200. Doesn't matter if that's 10 years, 20 years, whatever. Then, again, you've got a 25% tax rate. So when you withdraw the full $200, it's going to result in $50 of taxes. And the amount you have left for spending after all that is $150 because the 200 minus the 50 leaves you $150. Now, if we go to Roth, you've got that same $100. And you're going to have to pay taxes if you convert that money to Roth or if you contribute that money to your Roth IRA, your Roth 401k. Again, you're in a 25% tax rate today. So that's $25 in taxes, which leaves $75 that gets invested in your account. Again, the account doubles over time, becoming $150. There's no tax at withdrawal, assuming you meet all of the IRS requirements. So once again, you end up having that exact same $150. Now, some people will say, yeah, but I'll pay the taxes from an outside source here, so this $25 won't come out and I can invest the full 100. Okay, that's great. That's perfectly fine. But if you do that, then over here in the pre-tax scenario, you would also need to give yourself another $25 that goes into a taxable account and then also grows in your taxable brokerage, let's say, or in your bank account. That way you could keep it apples to apples. That's the case when the tax rates are equal today and when you take withdrawals. But what if there's a case where this is the case for a lot of people, especially early retirees, where they might be in a relatively low tax situation today, but they will be in a higher tax rate later. So you've got a 10% tax rate today versus 25 at retirement. In that case, everything looks exactly the same in the pre-tax area. You end up with that $150. Nothing really changed. The only difference is with the Roth situation, you end up paying $10 in taxes instead of the 25 because you're in that 10% tax bracket. That means you invest 90. It doubles. Once again, you're just using the exact same investments in either account. Becomes $180. And when you withdraw that, then you've got $180 available for spending. And that's a big difference from the $150 over here. That's an extra $30. And if you imagine this goes into tens or hundreds of thousands of dollars in your accounts, that can be a meaningful difference in your retirement comfort. But the opposite could also be true. We could flip-flop this before and after rate and say you've got 25% taxes today, 10% later. That's kind of the traditional way of thinking about it when people have typically recommended that during your working years, you make those pre-tax contributions. And that might make perfect sense. If you're a high-income earner, might not really make sense to make Roth contributions if your tax rate is up in the 30s, for example. Not going to walk through this whole example, but what you can see is down at the bottom line there. With that scenario, if you could make deductible contributions during higher tax years and then withdraw at lower tax years, you might come out ahead if you go that route. Okay, so that's the basic math, and we can see that it's the exact same outcome if the tax rates are the same and all things are equal. But all things are not necessarily equal, even if you end up having the same tax rate both before and after your retirement years. By the way, I'm Justin Pritchard. I've been helping people plan for retirement for over 20 years, And if you check the description, there'll be some resources that are basic education they might find helpful if you're thinking about these types of topics. So, how might things not be exactly the same in retirement, even if the tax rates happen to be the same number when you're putting money in and taking money out? Well, it's very easy to over dramatize these things, but there are a few things you really need to be aware of. One is your level of income is going to affect the tax rates you pay at. So typically, the higher your income, the higher the tax rates you are in. And your income could change based on the withdrawals you're taking out of retirement accounts or once Social Security starts, for example. RMDs, or required minimum distributions, that begin around your mid 70s could push your income up to a pretty high level that bumps you up into higher tax brackets. So that's a situation you want to plan out and be aware of and say, will I really be in that exact same tax bracket in retirement, or could those RMDs bump me up into higher brackets? Another issue is what's often called the widow's tax trap. And that's a situation where you might have a married couple and everything looks good. Your RMDs don't appear to cause any big problems. But if one of you should die sooner than expected, early in life, let's say, then the survivor would still have roughly the same income because those RMDs would just go over to them pretty much. And assuming you're, similar ages, a lot of assumptions here. But if that's the case, then the amount of income is now going to be in a single tax filer's bracket. So you don't have the higher numbers of the joint married filing joint taxpayer. You have the single taxpayer. And so you could easily get bumped into higher tax rates just from that. A couple of other things to think about are just changes in the rules. So lawmakers could tweak exactly how much income it takes to be at a certain level or at a given level of income. Maybe the tax rates change. They go up a couple percent or more or down. It just depends on what lawmakers are doing. Then there are things that maybe aren't necessarily taxes themselves, but are costs that are kind of like taxes because they're tied to your income. So that's IRMA, the income-related monthly adjustment amount. That's the surcharge you might pay on your Medicare premiums every month. If your income goes above certain levels, then you have to pay more than you otherwise might have had to pay. And that can add up to quite a bit. And again, for a married couple, it can really add up because a couple of things. One is you've got two people that might be paying it. The other is you could still have that widow's tax trap situation where you might be okay if you were married filing jointly, but as an individual, a survivor, you might end up having to pay more IRMA surcharges than you hoped. We also have the question of whether or not your Social Security income will be taxable. If you have significant assets, it's a pretty safe bet that 85% of your Social Security would be taxable. But for some people, there is some control and you might be able to get a healthy portion. I mean, you always get 15% of your Social Security tax-free, but you might be able to get even more of that. However, if your income rises above certain levels, that can cause your Social Security to be taxable, and that is effectively a higher tax rate on all of your income. And if you're taking qualified withdrawals that get that tax-free treatment, in that case, those withdrawals don't bump up the income that is counted to see if your Social Security needs to have more tax applied to it. So again, if you take income out of a traditional or a pretax IRA, 401k, that could potentially bump up your income, bringing more of your Social Security income into your taxable income versus if you were taking those withdrawals from Roth accounts, qualified withdrawals. In that case, it wouldn't affect how much of your Social Security gets taxed under current rules. And of course, there are a lot of other unknowns and moving parts here. We're predicting the future and trying to figure out what the tax structure might look like in your income and your longevity, the investment markets. It really can get pretty complicated. So who knows what the tax structure might look like. And if these decisions make sense today, given what you're looking at, they might not look quite as attractive in retrospect. And you can really get complicated here and look at, well, if I did convert, I would have those assets growing at a different rate as opposed to assets in the other accounts, like my pre-tax accounts or my taxable brokerage account, like we talked about before. It can really get complicated here. I'm not saying that any of these issues will arise for you, so don't get alarmed and start converting 100% just because you've heard a few videos out there. I want you to go into the decision of whether or not to do Roth conversions or whether or not to contribute to Roth accounts in your working years well informed. So look at that basic math, look at the long-term retirement planning stuff, and make a good decision. I hope you found that helpful. If you did, please leave a quick thumbs up, and I look forward to talking with you soon.